When you look at the stock market right now, it's very, very interesting. And in terms of trying to put things into perspective in terms of risk, when you take the total of all the stocks, all of them, and value them, they're worth more than twice the size of the entire U.S. economy. That is the Buffett indicator, which currently stands at 237. That means the market is priced at 237% higher than our national output. And when you talk about the Cape-Shiller ratio, it's at all-time highs as investors are paying over $40 for every $1 of normalized earnings. So there are no bargains in the stock market anymore. You're talking about optimism priced at something that is, I guess you could say, unrealistic. And that's all interesting. We talk about these metrics, but the bigger issue is what has been driving this overvaluation. And, low interest rates, we've talked about that. Leverage. The retail public is at all-time highs on margin leverage. So you have the retail public all in highest ratio ever or percentage ever in the public owning stocks, almost 50%. Highest amount of margin debt, like 1.6 trillion ever, and almost the highest amount of option exposure. So the public's all in on leverage and speculating. And this massive concentration that we see into a handful of stocks, is frightening. And you start to wonder what happens when you see something in this sector break. And what caught my attention is SpaceX, where their shares tumbled on Friday. They've lost $1 trillion in market cap since the IPO, whereby they let all of the public in and reduce the requirements by which an accredited investor would be allowed to buy IPOs. Now it's $2,000 and Joe and Jane Sixpack can do it. The company's market value on Friday was 1.63 trillion. It was at 2.64 trillion on June 16th on its third day of trading. So the point is that the public, who has been allowed through this stock to get in for the first time, they bend the rules on accredited investing, is left holding the bag on $1 trillion loss like that. And that's just beginning, right? What happens if it's NVIDIA or if it's, we saw what happened with IBM a couple weeks ago. It's been insane. And to expect this to continue, I guess a lot of people would say, no, it's just a little bit of a correction, but is it? And what happens if it starts to affect some of these 10 stocks? This is why you see Warren Buffett sitting on the sidelines, because he understands this. Further down this path, and again, I'm not trying to wash all of this in doom and gloom. I just want people to understand that perhaps the things that we are seeing are not as rosy as we are being led to believe. And it's important to understand that the mainstream media doesn't do a good job of preparing us for what's coming. Jim Cramer told everyone to buy IBM. It was one of his favorite stocks the day before it was destroyed in value. CBS News said this is a great company to profile, Roslyn Capital, a week after they fired their entire staff and a day or two before they collapsed. So the mainstream media isn't your friend. This is from, of all places, Fortune, which is mainstream, but they came out and said 49% of adults, young adults, kids out of college, are now living at home, up 12 percentage points since 2019. And it talks about how the fallout will reshape marriage, having kids, and home buying. And the data comes from a Fed's report, and it basically says kids 18 to 29, 49% of them are living with mom and dad. 47% of adults in that same age group receive help from someone outside their household to pay expenses if they're not living at home. And basically the gist of the article is when people stay home longer, it delays the ages in which they marry. This demographic shift impacts the markets. It impacts college enrollment, retirement ages, housing markets, etc. All of these things are connected. And really, this is me chiming in and saying, too, I have a cough drop here. It says, when a country chooses inflation, in other words, that was kind of the moral of what they were talking about. And I would say when a country chooses inflation to deal with its obscene piles of debt, these necessities of life, like home ownership, become way out of the reach of a growing number of citizens. This is what happens when you mess with Mother Nature and suppress interest rates. Home ownership becomes unrealistic, and we're seeing that with young kids living at home. And what does that look like down the road? My guess is it only gets worse, and we can talk about inflation.
The Fed maintains it isn't propping up markets, even as it's resumed large monthly bond purchases, quietly undoing years of balance sheet tightening under the justification of preventing market dysfunction. Critics call it QE in everything but name, arguing that borrowing costs would already be noticeably higher without it. At the same time, central bank gold buying has repeatedly outstripped what's officially disclosed. The World Gold Council has pointed out reporting gaps, sometimes several times larger than announced Q1 purchase figures in recent years. Governments quietly stockpiling hard assets while managing the value of their own currencies is, at minimum, something worth paying attention to.
Inflation, by the lying metrics of the Bureau of Labor Statistics, it came down last month. Oh, great, because oil was down. Bunch of nonsense, right? The petroleum reserve, the U.S. Strategic Petroleum Reserve, is at 96. It's lost 96 million barrels since March. It's at its lowest level in 45 years. And what's even more concerning is that 75, as they call it, critical energy assets have been damaged or destroyed across the Gulf region. And so, article I read said the common assumption is once that the war is over, everything will just be fine. They're saying that the wells are permanently damaged. You can't just turn them back on, and it takes a long time to get things up and running. And if that's the case, then inflation hasn't even begun to show itself. And you take there's only 43 days left of supply in the strategic reserve. If you take out what we've drained, well, how much higher would gas be? How much higher would inflation be? If we had real metrics of what inflation was or is, what would it really be? Anyways, and you can stop me at any time because I have a few more things to chat about. But so in thinking about all of this in the Federal Reserve, it's obvious to me that their balance sheet is never allowed to contract. And they talk about maintaining liquidity to support or prevent market dysfunction. That's all the bonds that they've been buying quietly, right? They stopped doing quantitative tightening. Now they're doing quantitative easing, but they don't call it that. They're just doing bond purchases in order to maintain liquidity and support or prevent market dysfunction. Well, could that be why the stocks remain elevated despite these deteriorating conditions, and the politicians who point to the stock market as evidence the economy is strong? They just came out and said that from July 14th to August 13th, they plan to buy an additional $10 billion per month, or over that period of time, rather, and $17.6 billion in reinvestment purchases, whatever the hell that means. And all I can say is that they say it's not to stimulate the economy or deliberately inflate asset prices. So you got the Fed spending money, no longer fixing their balance sheet. You got inflation that has been masked by the bleed down of the Strategic Petroleum Reserve that's only got a few days left. And this is getting worse. This war is not getting better. And what happens when the real lag time from this energy disruption is allowed to find price discovery? Inflation is getting worse. You take out the fact that the Fed is buying tens of billions in treasuries every month. Interest rates would already be higher. And so, I don't know. I think when you look at central banks and foreign governments and sophisticated capital quietly exchanging paper for hard assets every month. That should tell you all you need to know about where confidence is heading. And that's one of the central messages that I've talked about with you for a long time now, that price is a tool of misdirection, that you can see the lack of demand for the long end of the bond market. You can see the massive accumulation by the central banks, who told us that they bought 16 tons of gold in the first quarter. The largest first quarter ever in the purchases by the central banks ever. And the World Gold Council said, you're all lying. You bought 244 metric tons. You bought 15 times more than you're telling us. So the central banks know that the U.S. is facing accelerating inflation. At the same time, they are witnessing in real time a loss of global trust. And that the dollar is backed by nothing. And, you know, when I say loss of global trust, that's not hyperbole. Reuters talks about the worm turning, right? Says that only 11% of Europeans polled think the United States is an ally. I've been watching Tom Hanks' World War II series on the History Channel. It's incredible, by the way. If you're a history buff, watch it. It's like a 20 part series, and it's all real footage. It's very heavy. It's not for the faint of heart. But you look at what these kids, you know, are people who, God bless them, most of them are gone now, but what these young kids did to liberate Europe. And now here we are, one generation later, and only 11% call us an ally. All right, let's shift gears a little bit. Unless you have any questions, I'm happy to shift gears and talk about some gold and silver issues or bricks. Do you have anything you want to talk about so far? Kind of the point, there are so many things that are happening. It's important not to just focus on one. And I think you sum it up well. We live in a world that is very fluid and dynamic all of a sudden, and that has been distorted on many levels, largely due to financial manipulation and suppression of free markets. The distortions and the second and third effects of these distortions are real. And as things start to like the carry trade, the carry trade, which was the world's piggy bank that allowed to borrow in yen at zero and then reinvest it in assets like U.S. treasuries or stocks or other things around the world, created an environment where people thought this would last forever, and it distorted asset prices. But it was an orderly accumulation of assets, an orderly, for years, accumulation of these assets that created the leverage, which is synthetic, really, in terms of how would be if there were no carry trade. But as the carry trade unwinds, one could argue that it will be anything but organized. It will be chaotic as everyone runs through the door at the same time, trying to not get trapped. And so, yeah, these are things that I promise you there isn't a lot of people in the U.S. looking at that, average mom and pop, but we do, and John Rubino does. And when you talk about how that could become very scary very fast, it's real, because as it would unwind and asset prices collapse again, the second and third effects of that happening have other issues, as we have record margin debt, and then the margin debt explodes, and then it's forced liquidation, which it's a domino effect. And I think maybe this is why Warren is sitting in cash, and maybe this is why we're seeing deliveries on COMEX continue to rise. Now, again, I want to say something, and that is that taking delivery means taking physical, not paper. It could be a house account where it stays in the house account at COMEX. They want the gold in the vault, not rolled over, not a paper settlement. And that should be the signal under the noise, that the big bullion banks, or those that are doing this, are choosing the physical metal over the cash settlement. And I think while delivery notices don't necessarily mean that ounces immediately leave the COMEX vault, some do, what people should focus on is that they do represent an intention to take delivery. And when we look at July, especially in silver. It's one of the most active delivery months I've ever seen. In gold, as of Friday, I believe we had seen roughly 12,400 contracts stand for delivery, just under, which would be 1.24 million ounces of gold. And just doing a little basic math, what's that? 1,240,000 times, call it 4,100. It's $5 billion worth of gold that stood for delivery so far in July. And in terms of silver, the July 2026 COMEX contract as of the other day had 7,425 contracts delivered. That's 37,125,000 ounces, or 1,155 metric tons of silver. Now, again, that doesn't mean it's leaving the vault. But someone wants physical delivery over paper promises. They want those numbered bars in their account. So what is 37 million, 120 times $60? That's over 2 billion in gold. And I think it's important to note that. Couple more quick things. China acquired 48 tons of gold in May from London. It's the biggest monthly purchase in over a year, and that's 4.8 times more than the official 10 tons reported by China's central bank for May. They're lying about how much they are accumulating. Last thing I want to chat about, I know you got to run, is what's happening on July 24th, where China's biggest banks stop offering retail paper gold trading. And in other words, retail traders can no longer play the paper game. If they want gold after that, they'll have to buy physical or an ETF. But it's important to understand that it's the opposite of China turning bearish on gold. They're shutting down leverage. They're trying to find price discovery. And people have always asked me, why didn't China complain about COMEX and the LBMA manipulation? It's because why would they, if they know that price is artificially cheap? Why protest if you accumulate? So I guess I'll just simply say this. For years, they've played the long game. First, they bought the metal. Then they built the vaults like we're seeing, the exchanges, now the clearing systems and the settlement infrastructure. And only after that would you begin shifting the world's paper price discovery to physical price discovery. So could it jump immediately? Sure, it could. Maybe, maybe not. But every reduction in paper leverage means the physical market has more influence over time. And last piece is, don't be surprised if this recent pullback not only was the opportunity for the biggest buyers in the world to load up on cheaper prices, physical, you see these huge deliveries, while the weakness of paper holders gets shook out. It's how the public gets shook out. But don't also be surprised if part of it was the levered paper positions in China are forced to unwind. But come Monday, the Chinese retail investor who still wants silver won't have margin accounts. They'll have a choice to buy ETF or a bar. And I have an idea which one I think they will choose. So that's all I got. I know you got to run. Thanks for letting me go. It's just so much to talk about. I was blown away by how much I read that I hadn't heard about in a period of 2-3 days.
Perhaps the clearest signal shows up in delivery data. July 2026 saw one of COMEX's most active delivery months on record, with gold and silver contract holders increasingly choosing to take physical bars rather than roll their positions over on paper. China's moving the same direction. Its largest state banks shut down retail paper gold trading in July, steering everyday investors toward physical bullion or fully backed ETFs instead. Combined with years of vault expansion and new clearing infrastructure being built out, the pattern suggests central banks and major buyers are quietly favoring the real thing, treating the metal itself, not the paper claim on it, as the actual store of value.